So we've been talking for several years, mostly I think on the topic of risk parity. So my understanding is that you have been employing a risk parity concept, whether it was an allocation to all weather or your own internal risk parity formulation for a while. How do you articulate it? I mean, are the people that listen to this podcast and all of our other content, I think, are sick of hearing how we articulate it. So I'm always curious to hear how other people think about it and describe it and make it understandable and approachable.
Sure. Damien, you wanna start?
Sure. So I'm going to take it a step back, actually, and talk about, in our view, how to build a great portfolio, which I think is, this is very much an implementation of how to do that. But it's a limited implementation in the sense that it's just focused on things that are easily accessible, so public markets. And so our view on a great portfolio is lots of individually attractive return streams. Let's say return streams that offer you equity-like or better returns, but that are reliably different from one another. And that second part is the part that is probably the most underappreciated aspect of investment management. The vast majority of portfolios are full of lots of line items that are very closely related to one another. They're equity-oriented line items, and so they tend to go up and down together. There isn't a lot of diversification, reliable diversification in most client portfolios or most investor portfolios generally. And so risk parity is our attempt to look at what's available in the public markets and try to build something that is as consistent as possible by taking advantage of those diversification benefits. So that's how I'd say, and then we can get into the mechanics of risk parity, but I think it's important to start there because it's just not how people think about investing when it actually, in our view, is very common sense.
So what are the fundamental assumptions that inform a risk parity portfolio that are different from how many investors think about forming portfolios?
Yeah, I mean, and a lot of this sounds intuitive, but the way most people invest is they look for things that they think are going to go up over time. And they look for things that they think are attractive returns, and they just allocate to those. And then if those things are too risky, then they'll own bonds or other things to control the risk. And so when you approach it from that framework, you basically end up with a portfolio that has a lot of stocks and maybe high yield bonds or corporate bonds. Because the assumption is the expected return of those is higher than it is for higher quality bonds. And so if you're a longer term investor, if you're more comfortable taking risk, you should own more of those things. And if you're less comfortable or have other concerns or needs, you own less. And you scale up and down based on your risk profile. So that's the way that's the way
return expectations based.
Yeah, exactly. Yeah. Right. That's a simple way to say it. Thank you. Okay, so that's the way most people think. The challenge, though, is that if you follow that path, you could end up with a portfolio that is not very balanced. And balance to us means something that is not highly dependent on any single economic environment. So a portfolio that is equity centric or credit centric will do well when the economy is doing well, and it'll do poorly when the economy is doing poorly. And it also is not a great inflation hedge. So like in the 1970s, it would have done really poorly. And what's really interesting is because most portfolios are positioned that way, when bad times come and you lose money, you look around and everybody has lost money too. So it feels like that's the way it is. And we're all in this together. We're down together. Everybody just hold on. It's going to come back. So that's the philosophy. But there is a better way. And it's reliably better over the long run, but you have to dismiss the traditional way of thinking, the conventional wisdom. So the way we think about it, which is I think a different approach, is rooted in what Damien described, which is look for return streams that are attractive, that are different from one another, as opposed to what you just said, which is focusing on just the returns. And what is really surprising is you can take these traditionally lower risk asset classes and you can scale them up to give you comparable return on risk. So I'll give you a couple of data points, which I think might surprise a lot of people. So if you look at the last 50 years, global stocks have earned 8 to 9% a year for 50 years. Long-term treasuries the thing that nobody likes today, has had about the same return for the last 50 years. And you think about philosophically and conceptually, how can that be? How can a government guaranteed security have the same return as stocks, which are really risky? And it's because you can extend the duration and you can increase the risk. So stocks have a higher return because the risk is higher, and bonds have a lower return because the risk is lower. But you can equalize them, and you can do the same thing with things like gold or inflation-linked bonds or commodities. And if your menu of choices isn't just high risk stocks and low risk bonds, if your menu is a bunch of things that have similar returns and risk, then your framework for building a portfolio is a lot more advanced. And you can end up with a portfolio of asset classes that go up and down in different environments fairly reliably, that all have high expected returns, and you end up with a lot less risk. So that's the way I think about it in the framework that I hope makes sense.
The interesting thing about this conversation is that Rodrigo and I get to play a role on the other side, asking
I got
questions.
50 questions.
Yeah, that's right. That we hear all the time as challenges. One of them, of course, a timely challenge is the fact that government bond rates are a fraction of what they were 30 or 40 years ago. And so why should investors think that the returns to bonds, or the risk adjusted returns to bonds rather, over the next 10, 20, 30, 50 years are likely to be similar to the risk adjusted returns on stocks? How do you respond to that?
So that's a question I've been getting for about 10 years, right? So rates have been low rates have been falling for 40 years, right? You go to the early 80s. And 10 years ago, they were too low. They can't possibly go any lower. 9 months ago, they were too low. There's no way they can go any lower. And look at where we are now, right? So if you just look at US rates relative to the rest of the developed world, they're actually high, right? So they can certainly go lower. So that's point number one. Number two is rates falling has benefited bonds. It's also benefited stocks. It's benefited all asset classes. And looking forward, the expected return of all of them is lower, right? Because when cash is, I remember when I started in the late 90s, cash was yielding 6%, right? So you could have just bought cash and earned 6%, and stocks, you would expect a much higher return than that. Otherwise, who would take the risk of stocks to get something less? But today, cash is zero, right? And over the last 100 years, stocks have outperformed cash by 4 or 5% a year. That's where you get those 9 to 10% returns. When cash is zero, the expected return of stocks is low. So it's a challenging environment because cash is at such a low rate, right? So then the third point, and I'll let Damien jump in, is that the real question you have to ask isn't whether rates are going to go up or down. You have to ask what would cause that to happen. Right. So let's say, we're looking in the next 12 months. If I told you that the economy was going to suffer a devastating hit, more so than what's already happened, there's a good chance rates are going to fall further. And if you don't own that bond, right, you don't have the balance in your portfolio. And likewise, if the economy does really well, rates will probably rise and that bond will get hurt, but your other assets will do well. And so rather than trying to guess, because it's really hard to do that, I think 2020 is a perfect example of the difficulty in predicting, the markets and even the economy. It's, in our view, it's better to be balanced, and especially, in today's environment.
Yeah, I think I use the example of what did German advisors say to their clients in 2015 when yields were 0.75 in the German bond?
Right.
What's the point of owning these? They're only yielding 75 basis points. Who would own these? Who would own such things? Fast forward 3 years, and if you held a portfolio of German bonds, a 10-year, you would have annualized at just under 6%, right? Yeah. So this is the challenge, is everybody, I remember 2009, there's nowhere else to go but up in terms of yields. And here we are today. So certainly it's easier to
I do think you need to make some adjustments though, because if you're holding just very short-term bonds, there isn't much more room to fall. And so one thing that we're conscious of is we want to make sure that in a downside growth scenario, you're actually getting meaningful diversification from the bond portfolio. That's the role of the treasury exposure, is to provide a hedge to that downside growth scenario when equities are likely struggling. And so one thing we have done is we've moved further out on the curve where there's a lot more room to fall. So 30-year bonds in the US are 1.4%, which doesn't sound like a whole lot. But if we go the way of Japan and Europe, which, you know, is not an unreasonable assumption, those rates could be much closer to zero. And so that type of a rally with long duration bonds would have a meaningful return impact on the portfolio. And so that's one thing we've done, is we move further out on the curve. And then the other thing that I think is relevant in this environment is we've also increased our exposure to gold. Right. And so if you think about monetary policy, traditionally, it was to lower interest rates to stimulate the economy. That is a tool that has minimal, maybe no effectiveness at this point. And so now the way that central banks manage their economies, the way they stimulate is to print money. And initially it was to print money and buy assets. And now it's to print money and then turn around and have the government fiscally stimulate. So it's a print and spend policy. And so that environment, I think gold in many ways has become a barometer for stimulus that's likely to come in a weaker growth environment. And I think it can function in that way as a complement to the treasury exposure, where you don't have any sort of upside cap on how high gold can go. And in this environment, I think it's hard to envision a scenario over the next decade or two where you don't get a lot more printing from global central banks.
Can I just go back to your first point on going up the maturity? So in your implementation of risk parity, in lieu of levering up the bond portfolio, you're going up the maturity curve. So you're not choosing to lever up the short-term cash rate.
Yeah.
Is there an advantage? What is the advantage or disadvantage of choosing to go up the maturity curve versus levering? Have you guys put any thought into that?
We have. I mean, if you look historically, the shorter term bonds have a higher Sharpe ratio than the long term bonds. So I guess if you were to look at that narrowly and you say that the future is going to be like the past, you'd say, I'd rather lever up the shorter term bonds. The challenge is, of course, that shorter term bonds are offering you virtually no yield. And I think there are also challenges with managing a higher degree of leverage in the strategy, which, you know, also in a 40 Act context, that also gets challenging. So I think as I think about the future, because we're trying to manage this portfolio for the environment that we're in today, again, we come back to this notion of why are the bonds in the portfolio? They're in the portfolio, obviously to deliver a return, but also to provide outperformance in certain environments that are challenging for equities, and namely a downside growth scenario. And so in our view, that 30-year bond offers you much more potential return because there's just physically, you know, for the same amount of duration at the 30-year point versus the 10-year or the 5-year point, there's just so much more room for that rate to fall. That it's possible that, you know, you get better returns on a prospective basis from those bonds than you do from the shorter duration bonds, which, you know, may not be able
to get more. You feel like you get more convexity from the 30-year than you would from the levering up the short end.
That's right.
Okay, so it almost becomes, because that's another thing that I wanted to ask you guys about, is the idea of risk parity, is that you have balance across these different regimes, right? High growth, low inflation, high inflation. And yet empirically, we see that when there is a big growth shock, risk parity doesn't do so well. So one of the ways that you guys are looking into reducing that is by looking at high convexity options on that bond side. And I guess increasing the gold side as well. That would definitely.
Yeah, I mean, the question you really have to ask is, if you get a downside growth surprise, what's probably going to do well? And that's the question you should always be asking. So let's say hypothetically the 10-year treasury is at zero, and you ask that question, what's going to do well when you know the economy experiences a downturn? The 10-year is probably not going to move very much because it maybe goes negative, but it has limited room. The 30-year has a lot more room. And then you also, you know, in an environment where the Fed can't lower rates anymore, maybe they go negative, but they're near the bottom, they're probably going to print money. And that's good for gold. So those are I think if you ask yourself those questions without having to guess what's going to happen, you know, it's like an if then type of, you know, series of questions. of downside growth, upside growth, downside inflation, upside inflation, what's probably going to do well, and you just own those assets and you risk balance them. That's how you get a solid portfolio.
Can I push back just on that point? I want to. I haven't thought it through really. You said something that there isn't a lot of room with the forward guidance from the Fed. Really taking that zero bound out of the equation and allowing things to go negative. Can we truly say that there is less room? Is it more of a politically it's untenable and therefore there's less room, or is this a kind of a mathematical reality of some sort?
Well, I mean, there's less room than it was 15 years ago, right? Or 10 years ago, or even 1 year ago. So yes, you can go negative, but there's limits as to, at some point when you're too negative, people just hold the cash, right? You just run out of room, literally. And you're seeing some limits, globally. I think the lowest negative I've seen was negative 70 bips or 75 bips. So there is some lower bound. We don't know exactly where it is. Maybe it's zero, maybe it's slightly. Right now, they're telling you we're never going to go zero, but that may change in a crisis, right? So, so I think, but you're getting there. We don't know exactly where the line is, but we know we're a lot closer to it than we've ever been.
Got it.